With the fall season upon us, mid-October is important for investors. The final quarter of the year is underway, but we still await corporate earnings reports and U.S. economic growth data for the third quarter. Also, however, the holidays and the end of the year are ever closer, nudging investors and markets to look ahead to 2026. When we study the historical patterns of financial markets, we see that the calendar fourth quarter is often good for stocks. Over the past 26 years, starting in 1999, for the S&P 500 equity index, the fourth quarter has delivered a positive return 81% of those 26 years, the highest percentage of all the quarters, and the average fourth quarter price gain of 4.6% is the highest return. The last fourth quarter price decrease was 7 years ago in 2018, but it was a doozy, a drop of 14%. This year, investor sentiment entered the 2025 fourth quarter on a high note. The S&P 500 made 8 new all-time highs just in the month of September, and the index delivered strong 9-month gains through September. Key fundamentals remain constructive. So this was the backdrop for our October market outlook, titled Let the Good Times Roll. Through September 30th of 2025, the widely followed S&P 500 index increased 13.7% for the 9 months. Just 6 months earlier, the index posted a 4.6% decline in the first quarter, but then delivered solid gains in both the second and third quarters. Investors changed course in April as peak tariff and trade worries gave way to trade deals along with tariffs. This was important because it removed the near-term fears of an imminent recession, allowing markets to rebound from those extreme April lows. To be sure, now 6 months later, tariff and trade uncertainty is still present, and yet markets have moved much higher. We attribute those gains to several positive fundamental drivers over the past few months. First, corporate earnings growth in the first half of the year was well above estimates. Capital investment for AI and data centers has created a technology and investment boom. The 2025 budget bill was signed on July 4th, much earlier than expected. And now late in 2025, the Federal Reserve Bank, or Fed, has resumed lowering short-term interest rates, which can spur economic growth. Risks ahead include a resumption of a trade war, especially with China, inflation that creeps higher, eroding consumers' purchasing power, a weakening jobs market, and high expectations driving elevated valuations. And as we look ahead, we expect much of the good news to continue, but investors should remain vigilant, follow their investment plans through volatility, and moderate their total return expectations as they set long-term investment goals. This video will briefly touch on 4 key points in that quarterly market outlook, which we published in early October. Our S&P 500 fair value estimate is 65.50 with an upside range to 69.50. Growth momentum can continue, but look for value in other sectors too. The surge in technology investment is real, but the consumer is vulnerable, and earnings are increasingly important, and they do look good. Our S&P 500 65.50 fair value is modestly below the index level at the end of September, but we see a potential upside trading range of 69.50, which is predicated on continued strong earnings growth and an improving economic growth outlook for 2026. The S&P 500's valuation on a price to earnings, or PE basis, which takes the current index price divided by earnings estimates per share over the next 4 quarters, is 22.9 times, approaching a 10-year high. So we don't expect much increase in that PE level, so more gains in the index from here will be dependent upon earnings growth and not PE expansion. Another way to look at the high PE ratio is that expectations are high, which creates elevated risk as well. Leading the S&P 500 gains in 2025 were stocks in 2 growth sectors, communication services and information technology. We highlight the S&P 500 index to show that in 2025, all 11 macro sectors delivered an increase year-to-date through September, but just 4 sectors produced 2025 gains above that of the index. So 7 of the 11 sectors, while positive, trailed the index gains. So do we continue betting on growth, or are there opportunities in other areas? And we conclude a little bit of both. Above average earnings growth has driven the growth stock's strong performance, but those sectors and many stocks in them now trade at premium valuations. Most would agree, though, that stocks that can sustain higher earnings growth often deserve to trade at higher valuations. And if we look at the PE to growth rate, that allows us to compare an adjusted valuation for a high growth sector versus a low growth sector. Looking at the 2025 PE divided by the estimated annual earnings growth over 3 years, The S&P 500 PEG ratio was about 2.0 times. There are 5 sectors that traded at a PE to growth ratio lower than the overall index, and those were technology, materials, financials, communication services, and healthcare. Importantly, using this analysis, the strong sector performance of the growth leaders, communication services and technology, appears justified by earnings growth despite relatively high valuations. But other sectors traded a PE to growth discount as well and could be considered. We measure U.S. economic data from the Commerce Department's Gross Domestic Product, or GDP report. In 2025, reported GDP decreased 0.6% in the first quarter and then increased 3.8% in Q2. Those numbers were skewed, however, by companies changing behavior due to tariff expectations impacting imports and inventories. But we focus on the contribution from consumer spending and business investment, which combined are 84% of GDP, and we see that the contribution from business investment in both quarters was at a multi-year high. Consumer spending was positive in both quarters, but below 2024. The good news is that the consumer was stronger in Q2 versus Q1, and we believe the third quarter was strong as well. And market bulls will need this to continue. This puts pressure on corporate earnings results for the third quarter, and the reporting season for those September quarter results began over the past several days. S&P 500 earnings this year increased 13% and 12% in Q1 and Q2 respectively, and that growth is expected to slow to up 8% in Q3. However, for the past 9 quarters, actual reported earnings exceeded the pre-reporting estimate by an average of 480 basis points. We don't think that the market requires an upside surprise that large, but we do believe that investors are expecting results to exceed estimates. And we look for continued growth from the technology and communication sectors, and the banks are looking good as well. We are acutely interested in results from consumer-facing companies, as that will help us judge the potential for further sustained gains in consumer spending in the quarters ahead. We're constructive for investment returns in the fourth quarter. Stay the course, remain diversified, and use volatility to rebalance portfolios. Elevated valuations could limit expected returns in future periods, but market fundamentals have justified gains this year in our view. For specific recommendations and strategies, please contact your D.A. Davidson financial professional.